Let's have a look at our big stories of this morning. It's all energy, it's all inflation, and it's all economy. US gasoline prices, petrol to the rest of us, have hit an average of $5 a tank in the US for the first time in history. We are looking at the knock-on effects now with Justin Dargin. He's a senior energy and geopolitical expert at the University of Oxford. Justin, good morning. Thanks for joining us.
Good morning. Thank you for having me.
Remind us, what has pushed fuel to this price? Is it simplistic to just say that it is the war in Ukraine?
Somewhat, I would say so. It's actually, we could say, very strong movements that have occurred both on the demand and the supply side. So if you look at over the past several years, actually, I could even say over the past decade, there has been a significant amount of strength in the boom and bust cycle. So if you go back to the global financial crisis in 2008, and then, of course, from 2014 to 2017, and then, of course, at the start of the pandemic. So if you're an oil company executive and you're wondering whether you should make that strategic decision of investing millions of dollars into increasing oil production, you might wonder whether that's a winning proposition to do so, considering all of the volatility that's in the market. And then in addition to that, you also have bottlenecks that are in the refining sector. So even if you are able to produce additional amounts of oil, you still have to turn that into gasoline. And there have been refinery shutdowns in the U.S. over the past several years as well. And then there are, as you correctly indicated, the political and economic ramifications of the Ukraine war. And then you also have on the demand side as well. So the job market is relatively strong in the U.S. We have in the U.S. there's one of the lowest unemployment rates at about 3.6% or so. And then this pent up demand that is occurring as the lockdowns have eased over the past year. So all of this is contributing to this, fairly high gasoline price that the U.S. is experiencing at the moment.
So what do higher prices at the pump generally do to demand? At what point do we get what economists like to call demand destruction?
Well, that's a very good question. About $5, you could say, is the price where consumers stop from making lighthearted jokes about the price of gasoline to making strategic decisions on whether they should take that extra trip that may not be necessary. So we're going to start to definitely see demand destruction at $5, and then when it potentially goes up to $6, we will definitely see that. So it's going to happen, and I would say it's going to happen soon. But right now, what we're seeing is that consumers haven't really cut back on their gasoline purchases, but we are starting to see a cutback in purchases trickling into different sectors. So such as many of the retailers are experiencing a certain amount of slowdown in consumer spending.
Is that all gas prices, though? I mean, do we need to put this in context as to what is real and what is psychological? I mean, cars are a lot more fuel efficient than they were a couple of decades ago. So the amount of money that you're actually spending per mile is actually lower than in the 1980s, just because cars are better. And if we adjust the prices for inflation, they're not quite at the record highs that we think they are either.
Yeah, well, that's absolutely correct. So if you look at the role the energy price plays in the increase in inflation rate, it's only about 2.4% or so. I mean, so another aspect of that is that simply during the pandemic, there was a large increase in the money supply. I mean, so oftentimes this is neglected in the discussions of the increase in the inflation rate. So you're absolutely correct. I mean, so there are different forces at play. And then in addition, there is a fairly strong job market as well. So this also adds a fair amount of inflationary pressure, and with the resultant increase in wages, increase in the salaries that companies are giving to the workers.
But again, adjusted for inflation, those increases aren't necessarily the increases that they might be on paper. Let's dig into what it means for the rest of the economy. I mean, you mentioned retail there as one of those that takes a hit when people feel poorer. With consumer spending being 70% of the US economy, what are the longer term, the bigger knock-on effects of this gas price?
Well, interestingly enough, what economists are hoping is that the increase in energy prices will actually start to cool the economy. I mean, so that's one level of the discussion that's not necessarily being promoted as much. So there is a hope that consumer spending will actually, demand will actually start to decrease from these increases in energy prices. But in terms of the long-term effects, the problem is the U.S. economy can potentially tip into a recession. So that's one thing that many of the policymakers are really trying to avoid, really at all costs. So you have to really, it's a tight balancing act. You really want to slow down an overheating economy and the high inflation rate, but at the same time, you definitely don't want to tip into a recession.
Because that cooling that you mentioned is a double-edged sword, isn't it? I mean,
It is.
it's good for prices, but it's not good for businesses.
That's true. That's true. But there's one other thing to consider as well. High energy prices aren't necessarily net negative for the U.S. economy, seeing that the U.S. economy is one of the world's largest energy producers. So if you look at the states where the majority of the energy companies are located, so if you look at in the South, for instance, these states are experiencing a boom because of that. So an increase in tax revenue, increase in hirings, and also increases that ripple across the various economic sectors as well. So the U.S. does benefit from high energy prices at the same time. So that's one part of the discussion that also must be considered.
And just a couple of minutes left with you, Justin. What's it actually going to take to bring fuel and energy prices down?
Frankly, either a decrease in demand or an increase in supply. And it really doesn't look like there's going to be any increase in supply moving forward because there simply have not been the investments made in order to increase production. And many of the countries in OPEC Plus, excluding the UAE and Saudi Arabia, of course, don't have the spare capacity to be able to even meet the increase in the quotas that OPEC Plus announced about 2 weeks ago or so. So it's really going to have to take a decrease in demand, I would say, moving forward. But from this point onward, it looks like prices are actually going to increase. It doesn't seem as if there's much relief in sight unless something quite dramatic happens.
And 1 minute left with you. When we weigh all of this in with the inflation data that we've also seen come out a few days ago, what could it mean for the Fed meeting and the Fed's decision this week?
I think we can expect rate hikes, and the Fed has been signaling that. So we can definitely see that moving forward because the inflation rate is of great concern to the Biden administration, and President Biden has had some of his lowest approval ratings recently. And as we move into the midterm elections in November, they're going to want to move in, showing that they have taken steps to tackle inflation.
And Justin Dargin is a senior energy and geopolitical expert speaking to us. He works for the University of Oxford.